Welcome to today's tax webinar. Tax season is over, but we are going to keep talking about taxes. There's nothing more exciting than taxes, in our opinion. So we're going to go through how to minimize those taxes in retirement. All right. So starting off with today's agenda, I want to focus on two things. The first is going to be just some tax basics. That one's going to be pretty short. Just want to set some situations straight on how taxes work, dispel a couple of misconceptions. And then the second one, which is what we're going to spend a lot of time on, are the 9 ways to minimize taxes. All right, so here we go. So tax basics, marginal tax bracket, and the gift tax versus income tax. All right, so number one, the marginal tax. The thing I want to make very, very clear is what's written here on the left. Moving into the next tax bracket does not mean all your income starts getting taxed at that higher rate. If you look at this chart here, you see there's a 12% bracket, there's a 22, 24, 32. It goes even higher than that. But you notice, if we go all the way to the right, the married individuals filing joint returns, that 12% bracket goes from 19,901 to 81,000. The moment you go over 81,000 does not mean that all of your income starts to get taxed at 22%. The first 20,000 or so is going to get taxed at 10%, and that 19,900 to 81,000 is still going to get taxed at 12%. Doesn't matter if you only make, $50,000. Doesn't matter if you're Warren Buffett and you make, several million or $1 billion a year. The first amount is going to be in that marginal tax bracket. All right. So that's the most important thing to remember here with this, with kind of these basic concepts with the income tax. The second thing that I want to bring up is the gift tax versus income tax. Apples and oranges. Okay. When you think of gifting somebody money, a lot of times people ask, well, how much tax are they going to have to pay on that, on their tax return? And there is no income tax on a gift. A gift tax and income tax are completely different systems. The gift tax is much more in line with the estate tax, which we're not going to talk a lot about today, but just know gift tax, income tax, two completely different systems. All right. So let's move on to, I'm sorry, let's not move on. So let me talk a little more about this gift tax. All right. So the annual limit is $15,000. That's the most popular number people throw out there. That's the most that people know about. And that is just one piece of the puzzle. So for people that gift more than $15,000 in a year, you also have what's called a lifetime exemption, a lifetime limit, which is $11.7 million right now. So if you give, let's say, $1,015,000, right? The first $15,000 would get eaten in by the annual limit, but then that next million would actually just come off of your lifetime limit. There's a lot of complexity to this when you start to get to those level of gifts. So you shouldn't just do that on your own. Make sure you're talking to your advisor before you do anything, especially over the 15,000. But the point is, even people that gift more than 15,000, there's a good chance that they're not going to owe gift tax. We talked about annual limit, lifetime limit. There is no limit when you give money back and forth between spouses, assuming both are U.S. citizens. You also are able to give an unlimited amount if you pay the medical institution directly. Say you have a friend or a family member that is going through a tough health situation and you want to pay for that health expense, you could pay $1 million. And as long as it's paid directly to the medical institution, there's no gift tax limit on that. Same with educational institutions. If you're paying for kids' school, or you want to help out a friend or anything like that, there's no limit on qualified educational institutions as well. So just a basic, gift tax 101. We're going to focus a lot today on income tax, but really important things to know about the gift tax here as well. All right. So here is the meat of what we're going to cover today. 9 ways to minimize taxes in retirement. Number 1, build wealth in the right accounts. So it's not just about investing, it's about the after-tax investment, right? So you have different types of accounts that are going to get treated in different ways from a tax perspective. There's the Roth, that could be a Roth IRA or a Roth 401k. There's traditional, which again could be a traditional IRA or it could be a traditional contribution to a 401k. And then there's after-tax accounts, just a typical brokerage account that's more or less a non-retirement account. So those are the 3 things, but let's dive in there. All right. So Roth versus traditional. All right. Roth IRA, you pay the tax now, it grows tax-free, and the withdrawal is tax-free. The traditional, you avoid the tax initially. It's this great thing. You contribute $7,000 or $6,000 to your traditional IRA, and in that tax year, on that tax return, most people are going to see a deduction, depending on your income, and you get to save taxes in that year. The downside of the traditional is that while it grows tax deferred, you don't have to pay tax on any gains while it's in the account, but when you withdraw it, that's when it's taxed. So if we think about these 2 different accounts, if your tax rate is expected to rise, whether it be your personal circumstances or it be change in tax law, contributing to a Roth in general makes sense. If your tax rate is expected to stay the same or fall, sometimes it makes sense to contribute to a traditional IRA or 401k. So that's the Roth versus the traditional. It's really about money going in and money coming out is the time frame when it's taxed. The non-retirement account, the after-tax account, that is taxed in any given year, depending on if you have capital gains or dividend or interest income. So if you buy something and when you sell it and you realize that gain, that is the year that it's taxed. There's no tax umbrella over that, the way that there is for a Roth IRA or traditional IRA. You're going to pay tax on anything that is considered taxable. So capital gains, dividends, interest, as we talked about. There's reasons to put money into those accounts, but a lot of times it makes sense to max out those Roth accounts, max out any traditional accounts, depending on the different strategies you're going to take into effect there. All right. So next here, I'm going to point out something special. This is kind of related to number 1, saving the right accounts. The health saving account is the best account of all worlds. It's the best of both worlds. All right. That is because contributions are tax deductible, just like a traditional IRA. Withdrawals are also tax-free, just like a Roth IRA. It's basically the best of those 2 accounts combined. The caveat is that you have to spend it on qualified medical expenses to receive that tax treatment. This is different than a flexible spending account, and that you get to keep this money for however long it's in that account. A flexible spending account is a use or lose it for most of the money. There's a caveat to the flexible spending account as well, but the thing I want to focus on is that HSA is yours. It is not a use it or lose it. So you want to be maxing out that health savings account as much as you can. Someone might ask, what if I don't have qualified medical expenses? So the thing I want to point out here is that this, again, can go for any future year. You could be saving in this account for 20 years, not spend a single penny, and then use that for medical expenses in retirement. Chances are in retirement or just some point throughout your life, you're going to have medical expenses for you or your spouse. And that's why this account makes a ton of sense. Even if you don't have medical expenses, let's pretend you're the healthiest person in the world. You can take this money out at age 65 with no penalty. The only thing is you have to pay tax on the distributions, but that's the same as a traditional IRA. So think of this as just a traditional IRA if you don't need to pay for any medical expenses, but it's highly unlikely. There's a good chance you're going to need this for medical expenses, and it's an incredibly tax efficient account. It's the best tax account that there is to be saving money for, whether that be year to year or for the future in retirement. All right. Number 3, consider Roth conversions. All right. What is a Roth conversion? If you see this little graphic there of the fishbowl, on the left, we've got the traditional IRA or 401k or 403b. Most of the time, it's a traditional IRA, and we're moving money, just like that goldfish, jumping into the other bowl, which is the Roth IRA. We're moving 10, 20, 100,000, it doesn't matter, depends on the tax analysis, but you can put as much money that you have in your traditional IRA or those other accounts into your Roth IRA. The caveat here is that when you do that, it is a taxable event. Someone would say, well, why do I want to pay taxes on that? Why would I want to accelerate the taxation by moving it into the Roth IRA before I need to spend the money? And the answer to that is going to depend on your short and future tax situation. So let's look at this. All right. So here's a great graphic that really shows all the different tax buckets. We've got the 10, 12, 22, 24% tax bracket. Those are ones that are on the lower end. Then we've got the 32, 35, 37% tax bracket. The tax bracket you fall into will depend on what income you have that year. Not every year is the same. So the reason we might want to do a Roth conversion is if you have a certain year where your taxable income is lower, that pushes you, maybe you're normally in the 32%, but that lower year, you're actually only in the 24, 22, or maybe even lower. That might be a year where we say, well, let's accelerate that income. Let's do a Roth conversion because we can take advantage of that lower 22 or 24 or even lower tax bracket. So we're maxing out those buckets as efficiently as possible based on what's happening now in your tax situation and what do we expect to happen in the future. Number 4, invest in a tax efficient way. Location, location, location. So it goes back to a little bit what we've already talked about, right? Your taxation depends on what account it's in. So if it's in a retirement account, think about funds with capital gains distributions. You don't have a choice. When a fund distributes capital gains, this isn't when you sell a fund, but when the fund sells stocks within it, it is forced in certain years to distribute those capital gains. And if you're holding that fund, you're going to incur that capital gain, and that's going to be taxed unless it's in a retirement account, like a Roth IRA, like a traditional IRA. So having funds with capital gains distributions in those accounts makes sense. Income generating investments. Think of, bond funds that are taxable. If those are inside of a retirement account, it doesn't matter how much taxable income is getting spit off because it's inside of that tax sheltered, tax preferenced account. Let's go to non-retirement accounts. If we think of exchange traded funds, those are generally very tax efficient. They're not going to have capital gains distributions nearly as much as some active type of mutual funds. Municipal bonds, there's a huge tax benefit to municipal bonds. So if you're able to benefit from the municipal bond taxability, and that's in a non-retirement account, well, then you're okay there. So you've got some investments, it makes sense to be in a tax sheltered account like a retirement account, and then others where you're having to pay tax each year. That's where you want to have a much more tax efficient investment vehicle. Last thing on this though, taxes are really important for investing, right? But they are the second most important. They're not the first. You don't want to let the tax tail wag the investment dog. So you want to be thinking about what is the economic reason I'm investing in this? So whether it's a retirement account or non-retirement account, that should be your first priority. Taxes should be second. Both are important, but taxes are second in this case. Number 5, again, this is mainly when you're in retirement, right? So donate via a qualified charitable distribution. What's a qualified charitable distribution? A lot of times you'll hear it called a QCD. And that is when you make a gift directly from an IRA to a charity. Well, why would I do that? First off, you have to be 70 and a half to do this distribution. It's coming from your IRA. You have to be 70 and a half. So you're generally retired when this is happening. You have to be 70 and a half. Why would I do this, right? So let's think about what happens around that age. Well, required minimum distributions from an IRA used to be 70.5. They are now 72. So if I don't need the money from my IRA, let's say it's a $10,000 required minimum distribution, I could instead say, well, don't give that money to me where it's going to be taxable. Just send that to a charity and let them have it. So that way it doesn't get taxed to me. All right. Well, someone might ask, well, why wouldn't I just take the money and then gift it to the charity as cash from my bank account after I put it in my bank account? Well, there's a difference between doing a QCD and the tax benefit of that on your tax return versus taking a cash, taking it out and donating cash directly to a charity and getting the deduction on what's called a Schedule A, your itemized deductions. So let's look at the tax return. All right. So as I said there, why not just donate cash from the bank, right? So we're getting into the weeds here, but I think it's really important for you to know, and it's really exciting for us to be looking at a tax return to see how this all flows, right? So 4A, that top left highlighted, $33,000 is an IRA distribution. Well, this person donated $20,000 through a qualified charitable distribution. So her taxable amount on 4B was $20,000 less, $13,818. So she didn't have to pay tax on that $20,000. It's almost as if it didn't even show up as income because it didn't under taxable income. And then if we go down to the lines below, 8B, we see her adjusted gross income was around 238. Her standard and itemized deduction, well, she didn't itemize. She didn't have enough stuff to itemize. It was just the standard deduction. So she got the full standard deduction and she got this donation to the charity through the QCD. But and the taxable income came out to the 194 there. But think about how this works, right? There's the tax itself, which you've saved, but that number 8B, adjusted gross income, 238, that is a really important number. That's going to affect a lot of things. One of those things being your Medicare premiums. So if you make over around 178,000, I think the next threshold's 218,000 or so, around those levels, your Medicare B and Medicare Part D premiums will go up. Well, if you look at where that itemized deduction line is, number 9 there, that is below the adjusted gross income. So if you gift to charity in a way a lot of people do, and let's say they even get an itemized deduction, it does not impact that adjusted gross income, whereas the QCD does. So anything we can be doing to get that AGI, that adjusted gross income down, is going to benefit not just the taxation of that, but also other thresholds that are going to impact you in other areas of your personal finances. All right. So a little bit of a complex kind of analysis here and review, but just know that QCDs are generally the best way to give to charity if you are over 70.5. Number 6, another way to give to charity is donating appreciated stock. All right, what's the benefit of that? Well, if you donate appreciated stock, that would still show up on your Schedule A, your itemized deduction, so it wouldn't affect your AGI. So no benefit with that AGI discussion we just talked about. But what happens is if we look at, well, let me go back here. So if we look at the benefit, you're not having to pay tax yourself on that appreciation. So let's run through an example here. It's on the next page. So a lot of numbers on here, but just follow me. Let's start at the top, okay? So purchase price. Let's say you bought a stock for $10,000 and the current price is $30,000. You have a capital gain of $20,000, right? If you sold that, a lot of people would pay a 15% long-term capital gains rate. If you held it for more than a year and you make a certain amount of income, most people are paying a 15% capital gains rate. That'd be $3,000. Well, if you just gift that, let's say you want to do $30,000 to a charity. If you just gift that stock of $30,000 directly to the charity without selling it, the charity doesn't have to pay tax on that. And you have avoided that $3,000 of tax as well, but you still get that $30,000 of deduction as if you had given it in cash. So that's the avoiding tax while receiving the deduction as if you'd given cash. The second bullet there, all the way at the bottom, if you like the stock, buy it right back with the cash. If you were going to give the charity $30,000 anyways, and you just gave the stock instead, you now have an extra $30,000 of cash. You could just buy the stock back, but now your new cost basis, which is an important thing from tax standpoint, your new cost basis is not $10,000, it's now $30,000, and you've avoided that $20,000 capital gain. So giving to charity through appreciated stock can make a lot of sense, especially if you don't have that ability to do that qualified charitable distribution. Last thing I want to talk about with donating to charity, okay? While these are really, really good tax efficient strategies to donating to charity, the only reason that you should donate to charity in the first place is if you have that charitable intent. You do not do it solely for the tax benefits, because if you think about it, you're giving away $1 and you're only saving, let's say, 30 cents in taxes. So there's no benefit from a tax standpoint only in just giving to the charity. It helps your tax situation, but only if you want to give to charity in the first place. These are two really important ways to do that if they apply to you. Number 7, gifting appreciated stock to children. So we talked about giving stock to charity, right? They don't have to pay tax when they sell it and they use it for their charitable projects. When you gift appreciated stock to children, that basis, we go back to this one, right? Purchase price, that's the basis, okay? That transfers to the child. So they still have a $10,000 basis and they have a $30,000 stock, right? Well, the reason that gifting appreciated stock to children can make a lot of sense is because they might be in just a different tax bracket than you. So if you're in the 20% rate, you make over $496,000 as a married couple or $441,000 single, you could gift that stock to children and they might only be in the 0% bracket. 0% for married is up to $80,000. So depending on their income, they might pay that lower 0% or lower 15%. But here's another thing to know about gifting to children. Depending on their age and depending on their in college, they might owe what's called a kiddie tax, which somewhat makes this strategy ineffective in a way. So you really want to be focusing on the kiddie tax. You should talk to your advisor or your CPA about that. But giving to the children can make sense. If they're over, I believe it's 24 or 24 and above, then they no longer are subject to that kiddie tax. And this can make even more sense depending on what bracket are they in, what bracket are you in. Number 8, tax efficient retirement plan for your income. Okay, so this goes back to those buckets, right? We talked about the Roth conversion. Why would we want to accelerate income? Well, for a tax efficient retirement plan, we want to think about where should the money come from in any given year? Should it come from a Roth IRA? Should it come from a traditional IRA? Where should it come from? And it's all going to depend on, again, what your tax situation is in that year and potentially in future years. So Roth IRAs, a lot of times it makes sense to defer those as much as you can. If we think about all that growth is completely tax-free, we want to take advantage of that as much as we can. So that's generally the last bucket we're wanting to touch. Traditional IRAs, you have a required minimum distribution at age 72. So once you reach that age, you're pretty much, you got to take that. Unless you do something like a QCD, that's going to show up as taxable income. A non-retirement brokerage account, if you're in that 0% capital gains rate, take advantage of that, fill up that bucket. But it has to be, you have to look at all the different pieces. You want to see, where's my tax bracket going to be that year? What kind of income do I have disposal to? Could I take it from the Roth? Could I take it traditional? And do that analysis every year to see how can I stretch these dollars the most, given all the different buckets that I can pull from. Number 9, move to a tax-friendly state. All right, you look at this chart, or I'm sorry, this visual. That is a picture of income tax. Income tax. We've talked a lot about income tax today, and you can see some states that are great out there. Those are states that are pretty popular because they have no income tax. But something that everybody should look at is not just the income tax, but look at sales tax, look at property tax, look at inheritance tax. The state that's right for you is going to depend on your specific situation. If you have very little income, let's remember that Roth IRA, right? That's not taxable. So if all your money was in Roth, an income tax free state doesn't really benefit you that much. But if you have a state that has no sales tax, that could. If you do have a lot of pre-tax money, a lot of money in a pre-tax 401k, traditional IRA, and you're retiring, Florida, Texas, those states, they can make a lot of sense. We're going to spend a little more time on this in the future, at a future webinar, but just something to put on your radar now, especially if you're getting close to moving. When you retire, think of a tax-friendly state. So let's look at all these one more time. All right. Number 1, building wealth in the right accounts. Number 2, max out that health savings account. Number 3, Roth conversions. Number 4, tax efficient investing. 5, those qualified charitable distributions are going to help you out with that adjusted gross income. Donating appreciated stock to charity helps you avoid that capital gain if you were to sell it. Gifting appreciated stock to children. They can potentially be in a lower tax bracket for capital gains. Number 8, tax efficient retirement income. Do I pull from the Roth? Do I pull from the traditional? Look at that every single year. And number 9, moving to a tax-friendly state. Looking at all the different types of tax, not just income tax, but look at what's the best state for your situation. So thank you very much for being here with us today. I hope you took a couple of things away from this. If you have any other questions, whether you're a client or not, don't hesitate to reach out to us. If you are a client, reach out to your primary advisor and they'll be more than happy to help with this. But taxes are a huge part of retirement. And that's why we think they're really important for us to be going over with you, really important to get it right for your situation. So don't hesitate to reach out to us. For our next webinars, I know I mentioned it a little bit already, but let's start at the top here. So retirement planning, the stuff you haven't thought about yet. Thursday, June 24th at noon, we get a treat. We get Drew Tignanelli, our founder, and we get Mike McCarthy, our CEO, are going to go over that partially non-financial stuff about retirement, which is really, really important. And then next, after that, in July, we have how to find a great place to retire. I know I just talked about that a little bit, but Alex is going to take a much deeper dive into figuring out what state is right for you. July 29th at noon. And with that, we again, thank you for being here and look forward to seeing you next time.